The joint communique issued by the G20 leaders also include the OECD-brokered global tax reform deal that has been already agreed by some 140 countries. The OECD estimates the new scheme will generate $125 billion in additional global tax revenue every year. Hyo-sun tells us more.
The leaders of the world's 20 wealthiest nations have formally endorsed a global minimum tax of 15% on big multinational companies during their first in-person meeting since the pandemic began. U.S. President Joe Biden hailed the deal as a, quote, game changer that's going to reshape the global economy. The most prominent feature of the deal, part of a reform plan inked by some 140 countries, is the 15% global minimum tax. This rate will be applied to multinationals with annual revenues of over $867 million, aiming to discourage companies from being able to avoid paying taxes by finding havens in other countries with low rates. Another vital part of the agreement is that it allows countries to levy taxes on large and profitable companies, not based on where they operate, but on where their goods and services are sold. The OECD, which is leading the initiative, estimates the scheme will generate $125 billion in additional global tax revenues annually after it comes into effect in 2023. Visit ads will be reallocated from about 100 of the world's largest multinationals, which could also include South Korea's Samsung Electronics and SK Hynix. The Wall Street Journal reported the major beneficiaries of the deal are likely to be rich countries, including the U.S. It explains Washington's additional revenues will be 15 times those of China. Hyo-sun, Arirang News.